Now, for more on the economy, we go to one economist who expects to see a weak but positive job growth number tomorrow. Jim O'Sullivan is chief economist at MF Global and a Bloomberg Best economic forecaster. We welcome him to the program. Jim, you do seem to see a bigger gain than consensus, right? You're looking for 85,000 tomorrow. Why?
Well, hi, Matt. It's, I guess, not all that different from consensus, given how far the errors can be on this number. I think consensus is around 60 or so, and we've got 85, so I wouldn't view that as a big difference. We've got 85 total. It's actually only 40 if you X out returning Verizon strikers. So certainly if you take out the strike effect, it would be a pretty weak number in terms of what we're forecasting. And we do have the unemployment rate up a tenth as well. So it's a number suggesting the economy isn't in recession, but it certainly would be a weak number if it comes along those lines.
But why do you see it that way? I mean, I was speaking with Julia Coronado from BNP Paribas a couple of days ago. She sees a loss of 50,000, including the return of the Verizon strikers. She sees us definitely slipping in to a recession, though she says it'll be a mild recession, but a long and choppy one. Why are you more optimistic?
Well, I mean, of course, in any given month, errors can easily be 70 or 80,000. So there's a lot of volatility in these data. But certainly if you look at the claims numbers so far, including this morning's number, there's been no sign of any sudden new deterioration over the last couple of months. The 4-week average in claims is running 414,000, which is actually down a little bit from a couple of months ago. So there's no sign of any sudden weakening in those numbers. And certainly broadly, the ISM indexes, the spending numbers that have come out this week, they don't suggest that the economy is in recession at this point. Now, they're not leading indicators per se, so that's not to say that we couldn't go into recession over the next couple of months. But as of now, at least, the weight of evidence does not suggest we're in recession.
Well, and you don't expect us to go into recession over the next couple of months, right? You think that growth will gradually increase throughout 2011 and pick up even more in 2012. Isn't that the case?
Yes. I mean, certainly for the next couple of months, I think it's going to be pretty sluggish. We're probably talking 2 to 2.5% for GDP or so. Over the course of the next year into 2012, we are looking for growth to start reaccelerating. But clearly right now, growth is quite sluggish. The confidence numbers have shown a recession-like drop. Obviously, the equity market has shown a near recession-like drop. I wouldn't say it's quite recession-like yet. And for the economy to start improving again, we will need to see confidence and the equity markets start moving up first. So right now, things are looking quite sluggish, and it is a legitimate debate whether we're going to go into recession or not. So it certainly is possible. But our forecast is we don't.
Is it, Jim, is it all about animal spirits? Is it all about confidence? I mean, we don't see more people building houses, right? And we definitely see Wall Street firms continuing to fire people. So where will the growth come from if not only confidence?
Well, confidence is always very important, particularly at possible inflection points or turning points in the economy. It's even more so. And obviously, there's a lot of uncertainty right now, with Europe in particular a big driver. We're after coming off the debt limit impasse in the U.S., so confidence is very, very important. Now, through all this turmoil, it does look like the economy is still growing. We're finishing up the third quarter, of course, in terms of data. We've been forecasting 2% for Q3 GDP, but if anything, the numbers are adding up a bit stronger than that. We'll get more data next week, but I mean, it looks like something more like a 2.5% or so quarter. But again, there's a lot of uncertainty here. Where we go from here remains to be seen. But again, as of now, at least, even with all this uncertainty, the economy is still growing.
Jim, we haven't really delved into Europe yet. You have, I'd say, a more optimistic forecast than a lot of the economists we speak to recently. What do you think is going to happen in regards to Europe, and how key is that in your 2.5% growth forecast?
There's obviously a lot of uncertainty with Europe. It's the big focus every day in the markets, even more so right now than the U.S. economic indicators in terms of driving the U.S. market. So certainly we're counting on the crisis, if anything, fading a bit, becoming less of a focal point in markets day to day. So, I mean, ultimately what that means is less worry about either A, sovereigns defaulting, and B, related to that, the banks taking a hit, and us seeing another major round of credit crunch spreading from Europe to the U.S. So that's what's the focus of markets right now. Obviously, there's a lot of worry about that there will be default, and it'll spread to the banking system, and the banks will take a hit, and there'll be another major credit crunch. So that's hanging over markets. And of course, when you get headlines that they're talking about recapitalizing the banks, possibly with some help from the governments, that seems to give the stock market a lift. But it's a challenge, of course, reaching agreement on any idea in Europe. So there is a lot of uncertainty now. I mean, we're counting on uncertainty over time fading and people feeling a little better, but not necessarily a full solution, but it has to fade as an issue for confidence to start coming back here.
Let's get back to the employment picture here. You're looking for a gain of 85,000, give or take, obviously. Private payrolls up 135,000. What about the unemployment rate? We're looking at 9.1% right now, but of course, this doesn't include people who have been looking for a job for a couple of years. It doesn't include people who have been disillusioned and dropped out of the labor force. When you're at a dinner party and someone finds out what you do, they inevitably must ask you, what's the real number? What do you see as the real number?
Well, you don't have to go to a dinner party for that. I think anyone on Wall Street is the same thing.
Or on TV.
Well, I think it's always true that, the so-called real number is higher than the official number. Whether that's true when the unemployment rate is 4% or whether it's 10%. There are always more people out there who say they would like a job but haven't been looking, and from that perspective have statistically dropped out of the labor force. So that's always true. And of course, the BLS does report the U6 series, the so-called underemployment series, which also includes people working part-time who would like a job full-time but haven't been able to find, and that's running about 16%. It's down from its peak as well. I mean, that number was over 17% of the peak, just as the official unemployment rate has dropped from 10 to 9 or so. So the numbers are high historically, whichever way you count it, but the numbers are down from the peak nonetheless.
The reason I ask is that, if things improve, when things start to improve, inevitably you get people who dropped out of the workforce coming back in to look, and then the number blows up again, right? Is that a concern?
Well, no. I mean, that's always true. I mean, I think cyclically it's always true that labor force growth tends to pick up when the economy is strong and slow when the economy is weak. And that's one reason why the unemployment rate doesn't go up more than it does during downturns and doesn't go down more than it does during upturns. But it never really changes the direction of unemployment. It always moderates the relative moves. And again, I would say what we've seen in this cycle in terms of how much the labor force participation rate has changed relative to the underlying trend is probably no different than you would expect given how weak employment has been cyclically.
All right, hey, Jim, thanks so much for joining us today. Jim O'Sullivan there of MF Global. He is a Bloomberg best forecaster, so he has a great track record.